who's winning in this economy right now?
The rich, guys like me. You know, we have gone from having 93 billion, top 400, in 1982 to having 2.4 trillion, 25 for.
Prices going up and recession striking everyone down are the most common concerns as we head towards 2024. But guess what? The rich aren't panicking about it. Today, we'll look at where you need to invest if you want to get rich in 2024. While people panic about the economic downturn and what it'll do to their jobs, careers, and investments, we'll discuss what you can do to get rich from it. Want to know how? Well, first, you'll need to think of the economy as a game where those who are rich know all the secrets.
Well, I don't think there's a particular risk in the economy over time. We will have recessions from time to time.
You've never heard any of them complain about the economy, have you? And you never will, because when the economy goes south, their investments go north. If that's something you'd like to have for yourself, we're here to tell you that you can. But before we get into that, you need to know what one of the greatest investors of all time, Warren Buffett, has to say about economic downturns. During an interview, he once said that the American economy is a wonderful machine and has worked since 1776.
In the fall of 2008 and early 2009, and that has had more consequences than other recessions have had post-World War II. But the American economy is a wonderful machine. It really works. It's worked.
He went on to cite the economic turmoil of 2008 and 2009. One of the most important things to learn from this is that recessions are just another part of the economic life cycle.
The American economy is a wonderful machine. It really works. It's worked since 1776, and it'll continue to work. But we will continue to have ups and downs.
But that's not all. If you manage your investments properly, you'll come out with more money than you initially had. Take a look at returns in bull and bear markets generated by the S&P 500 ever since 1932. You'll see that almost every single crash in the market was followed by a strong recovery. Are you beginning to see the full picture here? Know that there are ways you can manage your investment, even in difficult situations, to get the best out of them. And what this means is that stock prices going down isn't always a bad thing. Alright, now let's get down to the gist of it. Making investments and building wealth. We'll start by looking at some of the things that are likely to happen in 2024. Keep your ears wide open. You don't want to miss out on any of this.
For next year, are you optimistic about the global economy or pessimistic?
Pessimistic.
Pessimistic.
Let's talk about your view on whether the economy is going to slow markedly this year in the United States and maybe even lapse into a recession. Everybody sort of seemed to be predicting it for 2023. It didn't happen. Relatively fewer people are predicting it for 2024. That may mean it will happen.
When it comes to a recession, a few things are likely to occur and oftentimes come as a domino effect of one another. When a recession strikes, one of the first things that happens is people start to lose their jobs as companies look to save money. Which, by the way, is happening in 2024. Nokia laying off 14,000 workers is just one example.
Nokia today announcing a plan to cut as many as 14,000 jobs, which is around 16% of their workforce. That's as they report.
However, layoffs aren't the only thing a company does when they're trying to save up some cash. Oftentimes, certain businesses can resort to pay cuts. Now, these two might not seem like a big deal at face value, but believe us when we say that their impact on the economy can be devastating. It's common sense that when people lose their jobs or get a pay cut, they have less money to spend. This might not be too big of a problem for the economy if it happens to just one or two people. However, when this happens at a massive scale, it leads to loss of customer purchase power and confidence. What this means is that people won't be spending as much money as they did before. But that's not all. Most people will think things aren't looking so good right now, and will tend to save money given that they won't have confidence in the market. Needless to say, this will stop the circulation of money, the very fuel which the economy functions upon. Let's take the scenario a bit further. To get customers to buy products and services, companies will start to lower their prices. As they earn less money, the value of and prices of their stock will decrease. Looks like those companies who wanted to make money by laying off employees won't be doing so after all. Think this sounds a bit far-fetched? Do a quick Google search of mass layoffs. You'll see. And don't forget the aftermath of geopolitical tensions and conflicts happening in multiple regions of the world will have on different businesses. To top this all off, Forecasts have predicted that 1.2 million people in America alone are expected to lose their jobs in 2024.
Most investors, most Americans don't understand what the Fed is really trying to do to the economy. It would mean 1.2 million Americans lose their job over the next year. So
now, you're probably wondering, how's any of this going to make me rich in the coming year? Well, let's get right to it. You see, Warren Buffett, also known as the Oracle of Omaha, thinks that the recession will keep happening from time to time. We can't really do anything about it. Speaking about economic conditions and investing, he once said that, "Bad news is music to the ears of an investor." Interesting, right? Well, what Warren Buffett is trying to say is that you need to see the hard times as an opportunity. At this time, knowing the safe assets and the economic predictions for the next 6 months is crucial. For instance, it's the best time to invest in gold. You see, the Federal Reserves usually shrink due to increased unemployment, so the companies turn to gold to save their cash. And hence, a demand is created.
And instead, you use the $10,000 to buy gold. Now, for your $10,000, you would have been able to buy about 300 ounces of gold.
Another important factor to consider for the upcoming months is the natural disasters. You see, things haven't been good with the climate lately. Oh, and how can we forget the geopolitical scenarios? The tensions between China and Taiwan are set to cause disruptions in the global semiconductor industry. And then there's the Israel-Hamas war. Many countries are now boycotting American brands due to their support of Israel. For investors, 2024 will be a balancing act between short-term uncertainty and long-term opportunities. Russia's invasion of Ukraine fueled underlying geopolitical tensions and accelerated global geopolitical fragmentation. The breakdown in relations between Western countries and Russia has increased military risks. The main risk is a cyber attack by one state against another, which could open up a global conflict. The impact would be very high, and the global economy would fall into a deep recession with severe human consequences and large-scale deaths. It could take a nuclear form, which would have truly catastrophic consequences. The probability of this occurring is currently very low. Since the beginning of 2022, major central banks have responded to high inflation by raising interest rates and starting to reduce the size of their balance sheets. In October 2023, the rate rise stopped. However, there is a moderate risk that inflation will accelerate again in 2024. The consequences would be a significant collapse in consumption, investment demand, and a global recession. The transition of Western economies to clean energy has increased the demand for green technologies. China, which is a leader in the production of these technologies, could trigger a global trade war with rising prices. Demand for these technologies is increasing in Western economies. If China blocked exports of raw materials critical to the green transition, such as rare earths, it would increase the cost of decarbonization. These costs would force Western economies to consider a return to carbon, delaying the timeframe for reaching the 2030 net zero emissions target. A direct conflict between China and Taiwan is unlikely in 2024 due to the risk faced by those directly involved. However, tensions are high, and elections in Taiwan in January 2024 could provide an opportunity for China to raise its tone again.
The high-stakes presidential election in Taiwan.
A declaration of independence by Taiwan, for example, would precipitate the situation. Regardless of the trigger, a large-scale conflict would weigh on Taiwan's economy and the semiconductor industry, of which it is a global leader. The war would also have global consequences and attract military participation from the United States, Australia, South Korea, and Japan, and push the EU and other US-aligned governments to impose investment restrictions in China. Again, there is a risk of nuclear escalation, but the probability is low. China's slow response to COVID-19 shocks and a post-pandemic slowdown in economic growth had led the Chinese government to explore expansive support measures.
China's economic report card shows it lost some steam last year, held back by a property downturn and small-scale lockdowns across the country. The world's second-largest economy grew just over 8% in 2021, slightly above forecasts and well above a government target of 6%.
The risk is of triggering speculative bubbles and causing foreign capital to flee the country. The risk is a crisis of confidence in the country's economic productivity, which would decrease China's growth potential, consequently slowing down global prospects. If the military conflict between Israel and Hamas evolves into a long-term Israeli occupation of Gaza,
I do want to take you back out to this live image that we do have over the Israel-Gaza border as we follow the latest breaking news out of the Middle East.
other state and non-state actors may decide to enter the conflict by supporting the Palestinian cause. The chances of Iran becoming directly involved in the war are slim, but it could use its influence with proxies like Hezbollah in Lebanon to prolong and expand the scope of the conflict. Now, let's talk about where to invest.
We both had a fair amount of experience in real estate, and Charlie made his early money in real estate.
When it comes to real estate, it's important to remember that markets vary greatly by location. While some regions may remain resilient, national housing prices could potentially see a 10% decrease or even more if interest rates continue to rise. Certain areas like Florida, Arizona, Idaho, and Southern California may face declines of up to 30% from their peaks. For homeowners with fixed-rate mortgages and long-term plans, these shifts may not be a major concern. However, if you're considering property investment or a new purchase, a recession could offer appealing opportunities. Now, let's talk about cash. Historically, cash was seen as less favorable due to inflation, but during economic downturns, it becomes a safe haven. Having an emergency fund covering at least 3 to 6 months of living expenses, rent, utilities, food, and medications is crucial. Surprisingly, as of 2018, cash emerged as the best performing asset class. High-yield savings accounts outperformed the market. Many fund managers are holding significant cash levels, suggesting it can act as a hedge during a recession. Real estate opportunities may arise in specific locations, and cash can provide stability. Additionally, assets like gold can be recession-proof.
And instead, you use the $10,000 to buy gold. Now, for your $10,000, you would have been able to buy about 300 ounces of gold.
Remember to diversify your portfolio and stay informed to make informed investment decisions. Let's talk about gold now. Investing in gold and diamonds does not mean investing in jewels, but investing in raw materials, luxury or otherwise, which could grow in value in the future.
It would be worth, at today's market prices, about $7 trillion. That's probably about a third of the value of all the stocks in the United States. So you could have a choice of owning a third of all the stocks in the United States, or you could have a choice of owning that little block of gold, which can't do anything but...
Although these two investments are often considered in combination, in reality, we are talking about two very different sectors and two categories of instruments. Since the beginning of time, gold has been valued in human societies as a safe haven and a fungible good. 100 grams of gold is always 100 grams of gold, regardless of processing. On the other hand, the quality and cut of diamonds vary, and they are not interchangeable. You can think of investing in the former in a financial sense, while for the latter, things become much more complicated. The decisions we make about diamonds will actually be the same as those we make about jewelry and artwork. Gold might be an excellent value store to preserve the purchasing power of your assets during this time of high inflation. The fact that gold cannot produce income like bonds or shares does, however, need to be taken into account.
The second point is the more important point. Real estate is not a commodity, particularly developed real estate, more accurately priced most of the time. Now, during the RTC period, when you had huge amounts of transactions and you had an owner that didn't want to be an owner in a very big way and they didn't know what the hell they owned and all of that sort of thing, I mean, you had a lot of mispricing then, and I know a few people in this room that made a lot of money off of that. But under most conditions, it's hard to find real estate that's really mispriced.
It should therefore be viewed less as an asset to accumulate as the primary instrument of your portfolio and more as a type of insurance in which to invest a small portion of your assets. Now, to take advantage of a recession, one of the first things you should do is hold your cash, but not all of it. A good 10 to 15% of what you plan to invest should be enough. Once that's done and dusted, cut back on your expenses and focus on diverting your spending toward necessities, not luxuries. Remember that a recession will end sooner or later, and companies will start hiring again. So another thing you should do is invest in learning. Master new skills and see opportunities line up for you. Lastly, keep a diversified portfolio. This includes investing in large cap stocks, assets that generate passive income, and real estate. Always remember that, as with any investment, there are risks associated. It is essential to be well informed and, if possible, seek advice from industry experts before making important decisions.